If you have a 9 to 5, tax deductions seem to be really hard to come by. There are five main ones that you really need to be utilizing. Of those five, they will bring down your taxable income, put money away into things you're already putting money into, anyways, with after tax dollars that you can be putting with pre tax dollars. This could save you anywhere from 15 to 30% just by making the right move. The first one we're going to discuss is pretty much the king, right? It's the 401k contribution. In many cases, you got to put money away for retirement. Your tax dollars now, in all likelihood, are getting taxed at a higher rate than it would when you're retired and you don't have any income coming in. So it does two things. You're putting money away for retirement, and you're also lowering your tax bill today. Now, why is that important? This is the easiest way to shift from just getting a paycheck and then, let's say, taking that money and then throwing it into your brokerage account, right? You're going to be doing the exact same thing except with pre-tax dollars. So you're literally taking a tax deduction on something you were going to do anyways if you planned on investing in the markets. Where the 401k is really masterful is you get a portion of your compensation in many cases from a 401k match. What is a 401k match? That's when your employer will say, hey, up to 3% of your salary, up to 6% of your salary, we will match whatever you put in your 401k, we'll also throw that in for you, right? So, what does that look like? Let's say you make $100,000 and you put away $5,000, and let's say they have a 5% match. The $5,000 that you put away gets matched. So now you have another 5,000 in. So now your brokerage account in your 401k has $10,000, as opposed to, let's say you had 100k of income and you just took 5,000 and put in a brokerage account, you still only earned 100,000. But with the match, you actually earned 105,000, and that extra 5,000 is not taxed to you. That is one of the most powerful features of the 401k. If your employer is offering 401k match, you have to accept it. You're literally leaving your compensation on the table if you don't accept it. Another tax tactic that is heavily underutilized. I highly suggest to see if your employer offers an HSA. This HSA is the most tax advantage account, even more tax advantage than your 401k. The money you put into it goes in tax free. It grows tax free. And then when you go and spend it on qualified medical expenses, it is also tax free. So if I had to really choose, I would say you go with the HSA, max it out. You also have to max out the 401k at least to your employer match. The beauty of HSAs that a lot of people don't know is once that account reaches a certain limit, uh, there's been cases where it's 5,000, 10,000. Once you have that kind of money in your HSA, it doesn't just sit in a cash account anymore. You will have the ability to actually put it in the market. And what a lot of savvy people do is they'll max out the HSA and pay for their medical expenses out of pocket. And they just let the HSA grow and grow and grow. And then before you know it, you basically ended up with two different retirement accounts, right? Your 401k and then also your HSA. Uh, oh, and by the way, when you take that money out later, your 401k is going to get taxed, but your HSA is not. It's one of those things that when a client brings me their basically their whole tax situation, it's really one of the first things I point out. Another item that you are probably not utilizing and is incredibly useful for people that commute to work, right? So many of these companies and businesses, some of them even without knowing, it's just something offered through their payroll services, right? So, for example, your ADPs, your Gustos, things of that nature, if you log into that account, there's a good chance that they offer something called commuter benefits. What is that exactly? Basically saying, hey, we're going to take a piece of your paycheck, we're going to apply it to this pre tax account, and in this pre tax account, you can pay for your parking, your commuting benefits. Although it doesn't apply to, like, paying your monthly car bill or maybe your insurance or things of that nature. But if you do travel, this is a way to get some money that you're going to spend anyways into a pre tax account, and basically you could save yourself up to 8% just by setting up that account. It's actually a lot more widely available than most people believe. And here's the kicker: if your employer doesn't offer it, it's almost a no cost obligation from your employer to start offering it. In fact, you can save them on payroll taxes if you say, hey, I want to start putting $300 away into this commuter account. Uh, it'll save you on FICA, it'll save me on FICA. What do you say? It would be very difficult for them to say no to that. Another fantastic one is dependent care FSA, right? So we have families, they got kids, they got to go into daycare while you're at work. And oftentimes, you're spending good money on that. What this tool does, it allows you to put some money away for that particular expense in your life. And that is also going to be tax free, right? So if you notice a trend here, it's all it's all money, it's all stuff you're spending anyways. You're putting money into retirement, you're putting money away for rain day, you're putting money, you're commuting, you have an fs you pay a nanny, you pay daycare, right? So these are all things that you are already paying for. You're just not getting the tax deduction for. And it's a real shame because we really don't have that many tax deductions as W-2 employees. We just simply don't. We have to use every single one. Another tax deduction that people may use but may not, and could be underutilized because not everybody will go into their student loan portal to see if they have any tax documents. Um, when you go into that portal, it's going to show you how much interest you paid for that year. And typically, W 2 earners that come out of college and whatnot usually will qualify for this. There are some income limitations, but for the most part, at least for your first couple of years, you should be able to take advantage of this. And that's another $1,500 deduction that you just aren't even reporting, right? So we just have to be really conscious of what we have available, right? We don't have home office we could write off anymore. There's a ton of deductions that we just cannot write off anymore, and it's a real shame. Um, but you do still have some tools. You do still have some avenues, and it's critical to use them. Otherwise, what are we doing here, right? Why are we paying money that we don't need to when I'd rather save $1,000 by just setting up a plan where I can pay for my nanny and childcare expenses, pocket that thousand, and who knows, you could go on a nice vacation with the kids for a weekend in a local area, or you can do something really good for the family. You can do something really good for yourself. So, really, at the end of the day, and really what I'm trying to drive with all of my content is keeping more money in your pocket and having it grow without losing, without it leaking. Because it's so easy for you see an account growing, you're like, wow, that's great, but it could grow so much more if you just put it in the right spots. I'm not going to continue ranting, but just to say, let's pick up every deduction we can in order to make our lives better and the people in our lives also better. Thank you so much.